We will be starting with the unit 1 of your JIB paper 1, that is principle, and the name of the unit is the Indian financial system. So friends, in this unit, see, before going to actual unit, why we are starting with the module A. So friends, see, module A consists of this around 11 units, and that 11 units are very important because this module A is nothing but the heart of this GIB paper first. So module A is the heart of your GIB principal paper. So after the module A, I recommend is the module E, because module E is recently added in your syllabus. So in the exam we expect more questions from the module E because it is new to you. So that's why the more question framing a question from the module E's chances are more. So let's move to the actual syllabus and the very first unit, that is the Indian financial system. What is the Indian financial system? So friends, see here, before going to actually Indian financial system, what is actually a financial system? See friends, financial system means a structure that is available in the economy to mobilize the capital from various surplus sectors of the economy and allocate and distribute the same to the various needy sectors. That means the transformation of savings into the investment and the consumption. So let's understand how it is. Suppose, see here, suppose we are working in a bank, like we are working in SBI, suppose, and what SBI is actually doing, it is accepting the deposits from the public and lends money to the borrower, or you can say industries, right? That means we are the people's saving is transformed into the investment. People saving is transformed into the investment. That means what is actually SBI or a banks, that is the financial, that whole thing is called as the financial system. That is the financial system, and banks is called as the intermediary because it acts as an intermediate that accept the deposits and lend money, right? So that is basic, it is the financial system. Now we will move to the next, what they are saying. See friends, there are some various segment of the financial market. What are the various segment of financial market? See friends, very first is the money market. What is a money market, friends? See, money market is nothing but the, see, it is the component of economy which provide short term funds, which deal in the short term. If funds are we are dealing in the funds which are for the less than period of 1 year, that is called as the money market. And vice versa, if it is more than 1 year, it is called as the capital market. Now things is clear, what is the capital market and the money market. Here you have to just remember the broad view, overview, right? In the upcoming units we will see all these in details. Very first is remember the basic things. Money market, funds are dealing in the very for short time, that is less than 1 year, and capital market more than 1 year. Now remember, money market provides liquidity to the capital market. This sentence is important. Money market provides liquidity to the capital market. Now what is capital market? That is the long term debt or security are traded in the capital market. Long term debt and security are traded. What is long term? That means more than 1 year, more than 1 year. Okay. Now what is the debt market? What is the forex market? See, forex market is nothing but the when foreign exchange is done. For example, dollar to rupees conversion, euro to dollar conversion, etc. That foreign currencies are traded in the forex market, right? That is nothing but the forex market. Okay. Now next is the debt market. What is the debt market? See friends, actually it is a market where debt instruments are traded, where various debt instruments are traded. Mainly government securities and the bonds are the major instrument, that is debt instruments. What is government security? It may be a central government security or the state government securities. Bonds, it may be FI bonds, that is financial institution bonds, PSU bonds, or the corporate securities. Okay. See some instruments of the money market they have given. So we'll take some brief about the some instrument about the money market. See, very first is the call or notice money. What is call money? See friends, when money is borrowed for a 1 day, it is called as the call money. It is called as the call money. 1 day, it is called as the call money. That is very for a very short duration. What is notice money? When money is borrowed for the period of 2 to 14 days, it is called as the short money, or it is called as the notice money. Okay, now we come to know what is the call money, what is the notice money. Next is the treasury bill. It is also the component of the money market, that is the instrument of the money market. T bill, it is called as the treasury bill. Generally, treasury bills are issued by the government of India, and the period for the treasury bill is it may be 91 days, it is maybe 182 days, or 364 days. That you have to remember. That MCQ can be framed on that. The T bills are issued by government of India, and for the period of 91 days, 182 days, and 364 days. Next is the term money. What is term money? We know what is call money, what is the notice money, and what is the term money. If it is money is borrowed for the more than 14 days, then it is called as the term money. It is called as term money. Call money for 1 day, notice money for 2 to 14 days, and the term money is for 14 days. Next is the CD, that is a certificate of deposit. Next is the ICD, that is the intercorporate deposit. Next is the CP, that is called as the commercial paper. Right, various companies issues the commercial paper. In the upcoming video we will be seeing in detail in the commercial paper, but here you can remember commercial papers are issued by the companies for the period 1 to 5 years, Next is the repo and commercial bills. What is commercial bills? Actually, commercial bill is nothing but the unsecured promissory note, and having maturity more than 270 days. Maturity is fixed, that is called as the commercial bill, and it is having maturity more than the 270 days. It is fixed, so it should be more than 270 days. That is called as the commercial bill. So we come to know what is the basic about the financial market segments. Now we will see role and function of a central banking authority. See here, roles and the functions of the central banking authority. What is the central banking authority? It is the RBI. What is central banking authority? It is the RBI, that is the central bank, right? So what actually RBI do? What are the functions of the RBI? See, central banking authority, that is RBI, has two distinct roles. Very first is the monetary control, and second is the monetary control. What is the monetary control? That includes the controlling the inflation, bank supervision, and second is role is the bank supervision. Very first is the monetary control, and second is the bank supervision. They are supervising the banks. Okay, how? See, monetary control, it is exercised through the CRR, that is cash reserve ratio, SLR, statutory liquidity ratio, and the bank rate and the repo rate. So you have to remember one line here. How monetary control is exercised, with the help of which ratio? Very first is the CRR, second is the SLR, third is the bank rate, and fourth is the repo rate. So through that rates, RBI is exercising the monetary control. Next is the central bank, that is the RBI, is the lenders of the last resort. What do you mean by last resort? Means when there is no option is available, the last option is the RBI. Suppose any bank is needed some funds and nobody is helping the bank, then RBI should act as the last resort to the banking system, right? In the recent case, we can see about the Lakshmi Vilas Bank. In the recently, how RBI intervened to save the Lakshmi Vilas Bank. That is the we can say in short that we can say last resort in the banking system is the RBI. Now, how RBI is ensuring the payment and settlement. See, what is the role of RBI in the payment and settlement? RBI also do the efficient payment and settlement. That means what is our NEFT, then RTGS, all is managed by the RBI. So payment and settlement, that all things are done by the RBI. RBI is also the bankers bank. That means all banks are supervised by the RBI. So RBI is also called as the bankers bank, that we all know. Next is the RBI can supervise banks by using RBI Act. How RBI supervises the bank? Using the RBI Act 1934. Next, RBI has a separate department called as the Department of Supervision for control of the commercial banks. Very important. The RBI has the department is called as the Department of the Supervision, that is mainly for the supervision of the commercial banks, because commercial banks contribute around 90% of your banking industry. So friends, see here some chart they have given. like a financial system. In the financial system, very first the central there are three regulatory authority they have shown. Very first they have shown the central banking authority. Who is the central bank? That is the RBI. That is the RBI. Next, capital market regulator. Who is the capital market regulator? Answer is the SEBI. You should remember, SEBI is the capital market regulator. Next is the insurance and pension regulator. Who is the insurance regulator? That is IRDA. That is Insurance Regulatory Development Authority. Next is the pension regulator. Who is the pension regulator? PFRDA. That is the Pension Fund Regulation and Development Authority. So friends, some important extra information you should remember. RBI headquarter is at Mumbai, that we all know. SEBI, important, remember, SEBI headquarter is also at Mumbai. And IRDA, that is Insurance Regulatory Development Authority, headquarter is at Hyderabad, right? And remember, PFRDA, that is Pension Fund Regulatory Development Authority, headquarter is at New Delhi. You can remember this information. Now, what actually in this chart they have just given some overview about the how they are regulating their markets. See how RBI is regulating the banking. See, through monetary control, that we have already learned. Through supervision, the bank RBI is acting as a supervisor to the banks like commercial banks, NBFC, primary dealers, financial institutions, etc., etc. What RBI do? RBI also manages the debt of the government. RBI also act as the banker to the government. RBI also act as the last resort to the banks, right? So RBI also control the CRR, SLR, bank rate, repo rate, that is MSF rate, right? So these are the basic function of the RBI. We will see all this in detail. Next is the capital market regulator, is the SEBI. How SEBI is regulating the market, that is equity market and debt market. Then supervision over the stock market, broker, etc., mutual fund, all that is regulated by the SEBI. Next is the IRDA and PFRDA, that are mainly regulating the IRDA is regulating in the insurance sector, and PFRDA is regulator in the pension sector. So we will see in detail about how RBI is a regulator. See, very first is the commercial bank. How commercial banks are regulated by the RBI. So friends, remember here, commercial banks are banks which include the public sector banks, foreign sector banks, and also old and new private sector banks. What do you mean by foreign banks? Like Sonali Bank of Bangladesh is working in India, so it is a foreign sector bank, right? Recently a DSB bank, that is there is also a foreign sector bank, right? Public sector banks means all nationalized bank, we can see. What is old and new private sector banks? Remember friends, old private sector banks are banks which are established pre 1992. For example, South Indian Bank, Karnataka Bank, Federal Bank, that are the old private sector bank. And new private sector banks are like ICICI, HDFC, Bandhan, that are new private sector banks. So okay, we come to know what is the commercial banks and how commercial banks are regulated. See, there is important thing, Banking Regulation Act. According to a Banking Regulation Act 1949, commercial banks are regulated by the RBI, right? Next, what is the NBFC? What is NBFC? See friends, there are very much confusing about the banks and the NBFC, but here we will see the difference in actually what is the banks and NBFC. NBFC stands for the non-banking financial company. It is non-banking financial company. NBFCs are also allowed to raise the funds. NBFCs are also allowed to raise the fund from the public, and also NBFC can lend through various instruments like leasing, hire purchase, and bill discounting. That you have to remember. The three words you have to remember. What NBFC do? NBFC do leasing, hire purchase, and the bill discounting. That all we will see in detail. Just you have to remember, because it can frame your MCQ question. Okay. Now see, NBFCs are licensed and supervised by RBI. You have to remember how NBFCs are licensed and supervised. It is by RBI. Okay. And RBI gives RBI also prescribes that the NBFC can operate without a valid license from it. That means for operation of NBFC, the RBI is issuing the license. That is the main thing. Now, what is difference between the banks and the NBFC? See friends, important. Banks are regulated by the Banking Regulation Act 1949, whereas NBFCs are regulated by the Companies Act 1956 or the 2013. Very important thing. There is difference between the act of regulation. Next, uh, for a commercial banks, there is a deposit on the insurance. That is for example, any if banks fail, there is a depository insurance, whereas there is no deposit insurance in the NBFC. If NBFC fail, all money will be lost. Currently up to 5 lakhs is insurance from the DICGC, right? That means there is insurance on deposit, there is no insurance for the deposit. Next, see here friends, there is no reserves for NBFC. There is no reserves, like no SLR, no CLR. They can lend up to any. So in case of bank, this facility is not there. They need to keep reserve for any crisis, right? For example, CRR, SLR, they need to maintain. But in case of NBFC, there is no need to maintain the reserve. Next, a transaction service is provided. Very important. For in banking, we are doing the transaction like NEFT and RTGS. The same system is not available in the NBFC. So that is the main difference in the NBFC and banks. Transaction is not allowed in the NBFC. Transactions are allowed in the commercial banks. So okay friends, now we have completed two important, that is banks and the NBFC. Now we will see what is the primary dealer. What is the primary dealer? See friends, very important. Primary dealer are also called as the PD. That is the in short, it is also called as the PD. Very important. See friends, it deal in the government security. They may frame a question that they are dealing in the government security. So you have to remember, primary dealer are dealing in the government security, and they are dealing with both primary as well as the secondary market. Though they are called as the primary dealer. Okay. See, basic responsibility to provide a market for the government security. What is the responsibility of the primary dealer? Is to provide the market for the government security and strengthen the government security market. PD are acting as the market maker for the government security. That means what you learn here, the work of the primary dealer is to ensure that the government security should have a good market for the trading. Right. So primary dealer are mainly dealing in the government security. Remember, only dealing in the government security. And remember, primary dealer are registered with the RBI and government security purchase and sale. The work of the primary dealer is the purchase and sale of the government securities only. So when you come to know what is the primary dealer, you should get to click that the second word, that is the government security. Now, for example, what are the example of the primary dealer? See, Morgan Stanley is the base. You might have heard the Morgan Stanley. So it is the best example for the primary dealer. Next is the Goldman Sachs is the best example. Next is the SBI, DHFI is also the best example for the primary dealer. Now friends, see what is the FI. Next is the FI, financial institution. That is also controlled by the RBI. We are we are learning all the institutions which are controlled by the RBI, that is the Central Banking Authority. See, what is a financial institution? See, a bank is also a financial institution, right? That means I don't think you need explanation in the what is a financial institution. Financial institution is basically which provide the long-term fund for the industry and agriculture. That is, bank are also doing the same, right? So FI raises the resources through the long-term bonds from the financial system and borrowing from the international financial institution, for example banks. So I don't think need much explanation in the financial institution. Banks are a financial institution. The work done by the bank is work done by the financial institution. You can remember easily. Now very important is the cooperative banks. See friends, cooperative banks, we all know what is a cooperative bank. There are different district cooperative bank. Recently Kerala government has amalgamated around the cooperative banks to form the Kerala bank, right? So mainly main target of the cooperative bank is to provide the rural credit, that is a loan to the rural area, that mostly give loan to the agriculture and allied activities. So important thing you have to remember here, see, the urban cooperative banks are controlled by the state governments and RBI. Remember, urban cooperative banks are controlled by the state government and RBI, whereas other cooperative banks are controlled by NABARD and the state government. That means one thing is common here. All cooperative banks, we can say true or false. All cooperative banks are controlled by the state government. True or false? Definitely true. All cooperative banks are controlled by state governments. Difference is the urban cooperative banks are controlled by state government along with RBI, whereas other than urban cooperative banks are controlled by the state government and the NABARD. That means difference is clear here. So friends, see, generally cooperative banks are providing higher interest rate on the deposits. That's why they are failing, right, goes to bankruptcy, because they are providing higher rate of interest on the deposits. Okay, now payment and settlement. That means what we have learned here, the cooperative banks are also supervised by the RBI. Next is the payment and settlement system is done by the RBI. That we have already learned, that is how NEFT and RTGS are processed, right? So you should remember, friends, what is the timing for the NEFT and RTGS. The timing for NEFT and RTGS are generally asked in the examination. For NEFT, right now, I think up to 7 p.m. timing is up to 7 p.m. from 6 to 7 p.m. and for RTGS is around timing up to the 7 p.m. Last time is 6 p.m. For NEFT last timing is up to 7 p.m. That is 23 batches, and RTGS ends at 6 p.m. right? So that you have to remember timing. So you should remember the timing for RTGS and NEFT. They are only the same question can be framed from that point. The payment and settlement system is controlled by the RBI, that we all know. Next is the management of government debt. See, RBI also manages the government debt. Recently, you have might have heard about news about the how the RBI has transferred around the 1.76 lakh crore of money that is surplus to the government. That means RBI is actually managing the debt of the government. That is the best example to you. Next, RBI act as the bankers to the government. That means RBI generally maintain the accounts and deposit of the government. That means we can say it act as the bankers to the government. Previously, or not previously, before some years, RBI was acting as an independent body, but recently, after the NDA government, RBI is really acting as the bankers to the government. For best example is the transferring the surplus 1.75 lakh crore to the government. Okay, next, what is the lender of last resort to the bank? What is the lender of last resort to the bank? See friends, when there is no option, if any bank need money and nobody is providing money, that time the RBI intervene and give help to that bank. That is nothing but the lender of last resort to the